Hello, everyone. Welcome back. And I will say welcome to my house. I'm recording from home today. There's a better than 50% chance that one of the four kids just comes walking through that door right there. So apologies in advance if somebody just kind of wanders along in the background. We are happy again to have Chris Cook, founder of Beacon Capital Management, join us for just about a 20-minute conversation today to get Beacon's input and take, if you will, on the stock market, the bond market. We're going to talk the third rail, politics again, as we did previously, and we continue our summer series, Chris being the second recording. So Chris, welcome. Thanks for coming back again, having another conversation with you. I'm always glad I haven't chased everybody off based on the last conversation.
No, it's always great, Lou. Thanks for having me.
Yeah, it's a pleasure. So as I mentioned, and it's early, we're May 16th. As I mentioned, to you, Chris, about this conversation, we'll keep it pretty brief, but we really want to get as much information as we can. So we are going to do as we did in the previous video and touch the third rail of politics, which is always super fun. All right. The candidates, as of May 16th, have decided to debate. I will say the two primary candidates have decided to debate. So they're amping up their we'll call it, word choice of battle at this point. Your take, Beacon's take on how that impacts both the stock market and bond market, please.
To be honest with you, as far as the debate goes, I'm not sure that it's going to affect, the stock market a whole lot, specifically. I do think, everything that I guess read and, heard, about the debate, or even before they actually agreed to it here recently, was that it's probably an opportunity for Biden to at least show that, he's still a sharp guy, a bright guy, and, has, all the faculties to do the job, versus Trump. So the point is basically Biden doesn't have a lot to lose is the general theory on that. But, when it's all said and done, these are two very well-known, candidates. They've both been in the public spotlight for decades, honestly. So everybody knows who they are. They know their positions. This is the first time, in a very long time, we've got two candidates that actually have a track record as president. So we kind of know where they stand. I think, and U.S. citizens, know where they are right now. It's probably more of a question of, who gets more people out to vote, and, it's like every presidential election, it's probably going to be pretty close to a 50-50 split. And, it's just going to be by a hair who really gets more people out to vote.
Okay. And with that, the impact on the bond and the stock market, in your or Beacon's opinion, looking at how it affects, and of course, Vanguard, since they are the 11 ETFs in the portfolio, how are they looking at, regardless of winning candidate, just the lead up to the election?
Yeah, you never know what happens after because, we don't know how Congress is going to fall either. And that's still up for debate too, where that's going to land on the House and Senate. But the lead up generally is pretty good for the stock market and the economy, in general. We kind of know how politics, works, the candidates that are up for election, and in this case, the president, they want to do everything positive, that they could possibly do to make, the constituents, happy, so, and that's what we're continuing to see. We're already starting to see that ramp up from Biden and Congress to do things that really are viewed as favorable by the largest majority of the country, and try to get votes. And really what that means is they like to push money out to people, and
We've seen that before, yes.
Yeah, exactly. It happens almost every single time. And, the stock market, it likes free money, so, you put money in the world and the economy, the US in particular is extremely efficient with capital. It takes those dollars and it puts them to work. And that turns out to be a good thing. And
Well, you've heard me say it before on these videos. We like our stuff.
we do. We do. We like to buy stuff.
We are a machine as it
Yeah.
applies to buying things. And how's this? That's no criticism. That's the way it is here.
Yep.
I was visiting Europe, and you don't need a car in Europe like you have to have one in America. So
Yeah.
hey, it's just a different economy, and no pun intended, but it drives much of the world's economy, which we'll keep it up. So we like our stuff. So with that, moving over to as everyone knows that has talked to me specifically about Beacon, and those listening for the first time or learning about Beacon are aware that you use 11 Vanguard ETFs, should say predominantly Vanguard ETFs in the portfolios that Tranquilli Financial Advisor is using. And that's all the compliant way of putting everything as part of this video. So if you could identify for us a couple of the sector holdings that are doing well, a couple that are not doing as well, and why do you see that out of those different sectors?
Yeah, that's a great question. So start with the obvious. This technology sector. So that's the sector that has gotten all the attention for really a few years now. It's driving the performance of the market. It's by far the largest segment of broad benchmarks like the S&P 500, where it's around about 30% of the S&P 500, and you branch off into the NASDAQ 100, which is getting a lot more attention these days as a mainstream benchmark, even though it's very specialized. It's probably about 50% tech. So, and even the Dow, which is kind of the old fuddy-duddy, index, it's increasing its tech exposure, on a pretty regular basis. So those companies are doing well. That's, they're very large, cash rich companies. So they don't care as much about interest rates, as they don't need to borrow money, to do what they want to do. And there's lots of, I guess, opportunities out there. Artificial intelligence is getting all the, the press now. So you just kind of mention that in a press conference, and the companies kind of get a little pop, just on just the future possibilities of artificial intelligence and what that does for these companies. So they're pretty obvious, and that's probably not going to change, for a while. I mean, we all know. I mean, we've always thought technology, is kind of changing society, but it seems to be accelerating now, and there's an opportunity for that. So they're going to do well. A couple that are maybe a little unusual that your clients may not think of quite as much on the negative side, real estate. It's doing okay, but definitely not as well as the rest of the market. And the obvious reason for it is interest rates. So with rates are going up, that makes, on the commercial side, development very expensive. This is how they finance things. So that gets difficult. Therefore, they have to start pushing up rents. And companies still have not found a way to get their workers back in the office, full time. The American worker is really, really, pushing hard against, coming back in the office, 40 hours a week. So these companies are trying to figure out, how much space do they actually need, and do they cut that back? And so that's having an effect. And then most of your clients, they're living it probably every day, on the residential side, homes, most of America, because we had rates at close to zero for so long, they refinanced their house, or they bought a house, and they have a mortgage at, give or take 3%, on average. There's just no way that they're going to want to sell a house if they have to get another mortgage for their next house and jump up to 7. That's more than a double. That's a real bill, that nobody wants to take on. So really nobody's selling a house, and the only buyers out there are cash buyers. And, you know, it's we were kind of joking about a little bit before. We like to buy stuff, which means for the most part, we don't have a lot of money saved up. We don't have that many cash buyers in this country, right? I mean, we're going to run out of them soon. So that's stalling out the whole, real estate sector for the most part. But the other unusual one that's on the good side is utilities. So this is one that really didn't do well last year, hurt us last year. They had kind of a perfect storm of no pun intended, of bad stuff. So they had a lot of natural disasters, from hurricanes to fires to Hawaii. They had the horrible fires and things like that. And the Fed was raising interest rates rapidly, and utility companies, a lot of people don't fully realize they finance their operations with bond issues. So that makes everything more expensive for them, and they were hit pretty hard last year. So it's not terribly unusual to see a rebound, in a sector that gets hit one year, that it comes back the next. But this year's a little unusual. It's kind of becoming this secondary play for artificial intelligence that I was talking about before with technology. And it's really because they supply the power, right? They control electricity, and everything that's artificial intelligence requires massive amounts of computing power. These machines that do this stuff are incredibly hungry, for power. And the way our utility system in this country is set up, there aren't that many. So it's expected that the demand is going to drive up the prices and therefore drive up their earnings. And they're kind of getting this weird little pop,
Okay.
from,
You actually,
yeah.
and it's called an ancillary benefit to AI.
Yeah.
So I want to stick on this for a moment, which we did not talk about beforehand, and it was almost like you were reading my notes I was making as you were talking. I wanted to get to that because it's rather illogical that utilities and technology are going up at the same time, because utilities are just the stodgy. You get a dividend out of them. The economy is bad. Utilities are good for this in the stock market because we're paying our bills, because we want the lights on and everything else. And then you have this AI push in the market. And I've sent out a specific video, and that's where I'm going with this, about AI and digital currency. And the fact that now AI, I do believe in. I believe in the future of it. I have to tell you that as a very minimal user of it, I'm not really sure where the efficiency is coming from just yet. Okay, so I think part of my job is to look at everything with the slant eye, if you will, because of investing for clients. So I am still, we'll say, very cautious with AI as it applies to digital currency. Not interested. I think it was said perfectly or stated perfectly by Nassim Taleb, who's a modern day philosopher, when he said it's already worth nothing because it's technology, and all technology is ever trying to do is replace itself. Mm-hmm. So if it's always trying to replace itself, whatever the current version of digital currency is, in a period of time, it's going to be replaced by some other technology. So this need of power, as you stated, for these really, well, not really, they are intangible items, AI and digital currency. Give any pause to the current market lift that we're seeing in your mind? Does it create any kind of, well, wait a minute, let's enjoy it while it's going on? I'm not trying to be the wet blanket here. But let's look at it all with a bit of a cautious eye.
I'm with you 100%. We do use AI. Me personally use AI in ways that I think are fairly extensive. But it's not to the point where it's life changing.
Hmm.
It does save me some time. It analyzes data, pulls out data that I want that I would have to do myself manually or something like that.
Very cool.
But uh, but it really isn't a game changer. And I do agree with you that you know uh, you know let's not pour water on it. Let's take it while the market is giving it to us. But be very cautious about it. Because we've seen, the next big thing, hundreds of times, throughout the years.
Yes, we have.
The last one that comes to mind, and I was just talking to a client yesterday that reminded me of this, and it was kind of funny. It was 5G, not too many years ago. Remember that?
No, I do.
All the companies were building out these 5G networks, and the speed that it is going to bring to everything from healthcare to just productivity to you name it. I mean, it was going to change the world. Well, and in fact, I still remember myself, holding out. So I've got an iPhone, an Apple iPhone, and I was waiting for the next model because it was going to have 5G on it. I really wanted it, right? Okay, I got 5G now. It does pretty much the same thing that 4G did for me.
Yeah.
My life seriously has not changed.
Not a bit. Yeah, that's
And
exactly.
I don't know
Your spam can get on the phone.
Yeah, exactly. I don't know that it's changed anybody's life, significantly. And you saw the same thing. All these stocks, anything that was 5G related, just run up, in a beautiful way, and it was fantastic at the time. And then they did nothing.
Excellent example. Yeah. We have to let's see it at work, truly at work. Now, your example of data and gathering data, excellent example. My example or my use of it would be, all right, write a nice email in Lou Tranquilli's tone and text kind of thing, which, anyone would be confused by both of those. But anyway, but assuming that it can do this, you have to edit the whole thing. It basically set it aside and said, all right, I'll get back to it.
Yeah.
So moving to the last topic, because we did promise to keep it, close to 22 minutes. Outlook for the remainder of the year. Give us the Beacon Capital Management outlook, stock market, bond market, remainder of the year. Again, May 16th, have a nice beginning to 2024. Feels good, looks good. Tell us what you think is coming. And of course, for compliance reasons, this is Chris's opinion, not a guarantee of any kind.
Yeah, absolutely. I mean, everybody knows that my forecasts really aren't that great, but I can tell you my thoughts.
That's what we're looking for. Thank you.
Yeah. So, we already talked about it's election year, so that tends to be a good year for the markets. The politicians like to flush the market, with cash, so that's always a good thing. And then once the election is done, all of the uncertainty is kind of over, and the markets adjust pretty quick to whoever the candidate is, and that tends to be a good thing as well. So it's just one worry you don't have to have, really after that. This year is kind of interesting. Inflation has not come down like a lot of folks, especially the Fed and Washington really want it to come down. It's very sticky, particularly with shelter and insurance and automobiles, which yesterday actually automobiles came down a little bit, but shelter and insurance is still a problem. And it's not like prices are coming down. It's just a lot of people don't realize inflation is actually measured from like point to point. How fast is it growing? It's prices are not going back to 2019. So people have to work harder to buy things. That's a real problem, and it is starting to finally hit some of the companies. They've been able to increase their prices and use inflation as the excuse, for that, which increases their margins and earnings. So earnings this year have actually been very, very strong. They're growing at a nice clip, which is what's kind of overcoming the fact that the Fed is not lowering interest rates. So that's countering that issue in a good way. But companies are now, with this current earnings season, the last couple of weeks, starting to come out and say, yeah, we're kind of out of room here. And, you know, an example that most of all of our clients, you know is McDonald's. You know, they have said, you know, recently, yeah, we can't charge people $12 for, you know,
A meal.
their meal deal, right? And even yesterday, I think they finally rolled out a value, you know, meal for $5 or something, for the first time, you know, in years. And it's really because people are starting to really pull back and make choices. And, you know, so earnings are not going to expand like they have. So that's going to put pressure on the markets. And I'm in the camp that I don't think the Fed is really going to lower rates much this year, maybe one time. And the real problem that they have, and this is kind of getting back to that third rail on politics for a moment, is that, you know, they're doing their job. They have rates, you know, high enough. They are restrictive. But we've got the other side of the house, you know, government in Washington flooding the world with cash. You know, so everything that they're doing to make people happy for the election, including even the CHIPS Act, where they're issuing just millions on millions of dollars to build, you know, manufacturing facilities for chips in the United States. And it's not that that's a necessarily bad plan, but that's a lot of money that goes into the world there. And I happen to be in Ohio, and one of them is only about 60 miles from here. And basically you cannot find a contractor or get supplies, you know, because everything is funneling to that facility. It's a massive facility that's being built. And that's pushing prices up, you know, across the board. So, you know, so Powell, you know, has issued a number of statements. You know, he's pretty political himself, you know, in a very nice way, saying, you know, you got to chill out, guys. You know, you're killing me over here. And, you know, but, you know, that's probably not going to happen until the election is over. And everything they're doing, even on tariffs, you know, Biden just announced, you know, new tariffs on China, which is also a Trump, you know, tactic as well. So it goes both ways. That increases prices. You know, that's inflationary to us. You know, companies, you know, they're not going to absorb, you know, a 25% tax effectively, all by themselves. So, you know, all of these things, you know, make it difficult for the rest of the year. So I think the market will probably be fine, but it's not going to churn out another 10%, you know, for the rest of the year.
All right. I think that we can leave it right there. That's just what we wanted to get to. Good basis for giving that thought of what the rest of the year looks like. And for everybody watching, you know, this is what I do. You're joining a conversation that Chris and I would have outside of recording it. So well done, Chris. Always appreciate you and the work that you do. And of course, these conversations. So we'll make sure we do it again soon.
Always. Thank you.
All right. And this is our second of the summer series. We've got a couple of more coming to you. We'll be talking with a few other money managers. So look for those, and we'll talk with everybody soon.